joined now by Dhiraj Nim, an economist and FX strategist at ANZ Research, who's joining us now. Dhiraj, a very good morning to you and great to have you on the show. What is really the outlook for India coming after a day when the FY24 numbers have been upgraded by global agencies?
Well, look, thank you for having me on the show. As far as the Q1 FY25 is concerned, my forecast is below consensus. I think growth could slip to about 6.4% year on year. As far as the whole year is concerned, I haven't really changed my 6.8% forecast, which is also slightly below the Reserve Bank of India's and I would say the market forecast as well. Now, in terms of the factors that I'm keenly watching, and of course, we all know that there was a bit of a government spending slowdown because of the national elections, which likely weighed on growth, perhaps a transient element. But we also need to see what's happening on the external sector. We could talk more about it and what's happening to the investments apart from what's happening to the public capex.
Dhiraj, a couple of triggers or cues that we've picked up on. Results of listed companies are very evidently showing a slowdown in profit growth. Rural demand, while is showing green shoots, the pickup is at a very early stage, and there's lower capex by the centre and the state government in the first quarter of FY25. Do you feel like all of this is concerning at this stage?
Look, I think we're in a bit of a transition stage, so to speak. We know that the government is consolidating the fiscal balances, and from the budget, we know that all that extra fiscal bonanza they've used to spruce up spending as well as consolidate the fiscal deficit. So, of course, if your fiscal deficit is going down so sharply, it cannot be strongly positive for growth. But we are thankful at least the capex budgets were not altered, and that could continue to support growth, especially this year and of course, over the medium term from a potential growth perspective. But as you speak of rural demand, I think these numbers will still not reflect the kind of recovery we are expecting in FY25 as far as rural demand is concerned. Look, overall monsoon has been good, and if you're tracking the Kharif sowing trends, they have been looking encouraging as well, about 2 to 3% up over the year, especially for crops like pulses and paddy, which I think should mean better realizations for the people involved in agriculture, and of course should mean better for rural demand. But I think that should only flow into the data from this quarter and next. So obviously, we'll have to wait to see the impact of those numbers. Now, coming to rural demand, I think there are several factors to keep in mind as far as private consumption urban demand is concerned. The first is, of course, that, there has been a bit of normalization from the post-pandemic surge or the post-pandemic pent-up demand surge, and that is still kind of playing out. But at the same time, we should be mindful that, a lot of the households are probably focused on building assets. We see the growth in housing loans, the real estate prices and everything. And therefore, with limited income growth, there's only so much scope for consumption growth to happen, if the households are building assets and their balance sheets are looking leveraged as well. So I think that urban consumption growth might at best remain modest. I think that most of the incremental growth will come from rural demand. But even so, I don't think private consumption will become a strong growth driver in FY25.
One quick word, because you do track the currency markets and the bond markets quite closely. It's completely priced in that the Fed will give us a rate cut as early. I'm saying us as if I'm American, but it's pretty much a rate cut for the rest of the world as well, as early as 18 September. What would that do to rate differential and do to our local paper? And also, more importantly, the dollar index has been declining all through August. Could that mean anything for the rupee? I do understand that the rupee is a relatively controlled currency, but nevertheless, could it mean good news on the dollar rupee pair? Could we be heading to higher levels anytime soon?
So as far as the rate differentials are concerned, look, we're still pricing in a much deeper rate cutting cycle in the US than in India. If the Reserve Bank of India gets to cutting rates, which we expect will happen starting December, it may at best deliver 3 rate cuts at 25 basis points each versus a much deeper rate cutting cycle we are expecting in the US. So of course, rate differentials are possibly going to turn in favor of the emerging markets generally, and India specifically. What should that mean for the bond market in India? Look, there was anyways a constructive demand-supply backdrop for the Indian bond market, the Indian government bond market, and onshore demand as well as foreign demand for IGBs is going to be strong in FY25 is our base case. So I think the fact that the market is now convinced that the Fed would be delivering rate cuts and it would be a good cycle of rate cuts, I think it bodes well from an external headwind perspective. But at the same time, after today's GDP, the market would also have some idea of what the Reserve Bank of India might do. And I think that as Reserve Bank of India goes into a rate cutting mode or rate calibration mode, let me put it that way, it could also mean, further gains for the bond prices. Now, coming to the rupee, look, the dollar has slipped by about 2.6, 2.7% month to date, if I'm not wrong, and the broader Asian currencies have rallied more by about 3.3%. The rupee has gone the other way. It's depreciated by about 0.3%. And I think it is not surprising. It sort of extends or reinforces the tendency of the rupee we have seen that if there's any sanguine development from an external headwind perspective, especially from dollar weakness, the rupee has mostly dodged that. And the reason could be the Reserve Bank of India is very much present in the market, buying on the dips, and therefore, building up the FX reserves. And since a lot of this, is being expressed via financial flows, the Reserve Bank of India is wary that should not appreciate the rupee and make it uncompetitive. Mind you, the real effective exchange rate for the rupee is still about 107, very much in the overvalued territory.
Very lastly, quick question, India's inclusion on the bond index. Have you seen a pickup in flows recently, or it's largely status quo? We don't talk about it anymore as often.
No, I think it's as good as given, but much of that inflow has yet to occur. The estimates were anywhere in the range of $28 to $40 billion. That's a wide range, but I think even if you're looking at $28 billion, which is the lower end of the estimates, I think about $10 to $11 billion of that inflow is yet to occur, and that will continue to happen because this is a phased inclusion. So yes, I think bond inflows will continue to happen, which should continue to guide the Reserve Bank of India's FX policy and liquidity policy as well.
All right. Thank you so much, Dhiraj, for speaking with us. So, of course, we'll be keeping a track on that data coming out today.